Welcome back, everyone. In this video, I'm going to be talking about price cycles. By the end of this video, you will have a foundational understanding of how to call price direction. You're able to know where price is likely to go or what price is likely to do next. And not just that, it will increase the chances for you to cite profitable setups. All right, let's dive in. In price, there are only four things that happen. Price moves in circles and it consists of four phases and only these four phases. And these include consolidation, expansion, retracement, or reversal. What does this mean? It means that these are the only four things price does. So when you open your chart, price could either be consolidating, price could either be expanding, price could either be retracing or reversing. So therefore, with this information, the core requirement to attain the skill to predict price movement will be one, how to identify each of these phases. Two, how to predict the next price phase that is most likely to occur. So now, consolidation. Let's start here. Consolidation is when price sits in a range. When price is not breaking above this range, neither is it breaking below the range. Now, I want you to be patient. I'm going to go to the chart to explain how you can identify consolidation with precise rules, okay? So usually in consolidation, this is when orders are being built, and this is the time to sit on your hands and not take a trade. And consolidation usually happens around area of equilibrium. Now, what does equilibrium means? When price creates a range, let's say price creates this range, is rallying lower. So we're making lower lows and lower highs. So lower lows and lower highs. So from this high to this low, price created a range. From this high to this low, price created another range. So when you take the high of this range and the low of this range, using your Fibonacci, the midpoint is what we call equilibrium. It's at this point you usually find consolidation. The next price phase is expansion. Expansion is a quick move of price away from equilibrium. So when you see price move away from an area, it is called expansion. And usually expansion happens after finding support or resistance from the ICT order block. So I'll explain all these things when we go to the chart. Now let's move to the next, which is retracement. Retracement is simply price pullback into the established range. So I explained to you what a range is. So if you have this higher high, higher low, higher high, higher low, higher high. So from here to here is a range. So this pullback into this range is what we call a retracement. So for a bearish market, lower low, lower high, lower low, lower high, lower lower high. So here's a range high and the range low. So this move back into this range is what we call retracement. And usually we see price retrace into an area of fair value gap. So to take trade setups, we want to pair fair value gaps with what? Retracement. Okay. Then the last is what? Reversal. Reversal is simply the quick change in direction after expanding to the opposite side. What does this mean? Price could be consolidating, meaning that it forms a range like this, and then expands lower. So this is an expansion lower, then changes direction quickly to the opposite side. So this is what we call reversal. And you can see we have what? Liquidity here, sell side liquidity. Price takes sell side liquidity and then expands to the other side. Let me give another example. Price could be trending higher, higher high, higher lows, grabs liquidity above this high, then change direction. So reversal actually is expanding towards both sides, but moving further in the second direction. What that means is price expands towards an area, takes liquidity, and then changes direction swiftly. So I'll go over it again. Here is consolidation. Here is expansion. Here is retracement. And then this is reversal. So price takes liquidity before reversing. So anywhere you see price taking liquidity before expanding, it is called a reversal. And liquidity is found above swing highs and below swing low. Now, what is a swing high? A swing high is formed by 3-candle pattern. When the candle at the middle is higher than the left and the right candles, we have swing high. And for a swing low is when the candle at the middle is lower than the left candle and the right candle. Now that we have the foundational understanding of how each price phase looks, let's talk about how they move from one phase to another. Now, when you see price consolidating, there's only one thing price will do next, and that's expand. Price will never consolidate and reverse, consolidate and retrace, but consolidate and expand. So when you see price consolidating, the next thing you are expecting is what? An expansion. Now, it could either expand higher or expand lower. Okay, good. Now, once price expands, there are 3 things it could do. Now, if it expands, it could retrace, like we see, price could retrace and expand again. So you see how it is interchanged here. It could expand and retrace, then expand again, like we usually see when price is trending. So price expand, retrace, expand, retrace. This is what price could do. The second scenario is price could expand and then reverse. What does that mean? You could see price consolidating, expand, and then reverse. The change is what we call reversal. But this here and this here are both expansions, right? Then the next thing price could do after expanding is consolidate. So price could consolidate here as we see, expand, and then consolidate again before expanding. So there are 3 things we expect price to do after expanding. And if price retraces, the only thing we are expecting is what? An expansion. We don't expect price to retrace and consolidate. We don't expect price to retrace and reverse. It's not possible. There's nothing like retracement and reversal. Just imagine price expands and then retrace. How do you expect price to reverse here? Except it expands again, takes the liquidity above this high, and then reverses. Okay? And if price reverses, the only thing that could happen is expansion or consolidation. What does that mean? Price is probably in this range. It reverses, so it could either consolidate again or expands lower. So when we understand this price movement from one phase to another, we can predict what price is going to do next. So let's go to the chart and I will explain how to identify each of these price phase and how price moves from one phase to another. All right, so here's the Euro USD. This is the 4-hour time frame. And you can see price has been ranging for quite a while. From this point to this point, you see price consolidating from August till now, which is 5th of September, when I'm making this video. Today is the NFP, so I'm expecting price to break out from this range. But how can you tell when price is consolidating? You want to have clear objective rules so that you don't guess in the marketplace. How can you tell? Once price creates a range, now if you look at this point here, we have a range from this low to this high. What happened? Price only retraced and broke out. Okay, now we have a new range from this high to this low. What happened? Immediately as price retraced, it broke out of this huge range. Then price created another range here. We have this high and this low. Price did what? Broke above it. Then retraced. Okay, we have another range from this high to this low. So it's just creating a low, a high, a higher low, a higher high, a higher low, a higher high. Then at this point, we're not getting any higher low or any higher highs. You see how price has been moving inside this range here, from this low to this high. See how price has been moving from this high to this low, from this. So it's not breaking above. It's not creating a higher high and a higher low because it's a bullish market. If it's a bearish market, we want to see a lower low and a lower high. Okay. Now, at this point, there's also consolidation. You could see how price created this high, this range high, this range low, and price was sitting here for quite a while until it broke below it and then rallied higher. Now, what we'll classify this? We'll classify this as a reversal. Now, remember from the previous slide, I said when price is consolidating, the only thing we expect to happen is an expansion. So you can see how price expands lower took out the sell side liquidity and then reverses. So this is a reversal here. Okay. So how you can tell that price is consolidating is if it doesn't break out of the range that was formed, it keeps dancing inside our range, it is consolidating. And the only thing you're expecting to happen is an expansion. Okay. So currently price is consolidating. Like I said, today's NFP, I'm expecting a breakout from this range. So after consolidation, the next thing is expansion. So if you go down to the daily time frame, the wicks are just the one going through the high and the low, but you can see that the body is within this range. Although in the 4-hour time frame, you could see the body here, but going to a higher time frame, you see that the wicks are just the one doing the damage and the bodies are telling the story. So now we know what the consolidation is with ideas of what an expansion, retracement, and reversal is. But regardless, I'm still going to show you an example of an expansion. So you can see this move here from this high to this low is an expansion. From this low to this high is an expansion. From this high to this low is an expansion. So from here to here is an expansion. So what's a retracement? You can see how price expanded from this low to this high and then retraced. So this temporal movement into this range, the low and the high, is what we call a retracement. And then what is a reversal? A simple way to tell price reversal is if price reverses the opposite direction after grabbing liquidity. Okay, let me show you an example quickly. Let's go to the 1-hour time frame. You see this here. This is a reversal. See how price grabbed liquidity. Took liquidity and then did what? Rallied higher. So it's a reversal. Okay, let's look for another example. Good. There's another example here. You see? Here, price took liquidity. So what happened? You can see how price was trending. Higher high, higher low. Higher high, higher low. So let me just outline it. From this high to this low. So you can see that price consolidated a little bit here just for a short period. Then the price took liquidity and then reversed. So this is a reversal. Let me look for just one example and show you. Here it is also a reversal. Price was trending lower. So as soon as price took the sell side liquidity, it will change direction. So when there's a change in direction after liquidity has been taken, it's what we call reversal. Now, how can you use this for a trade setup? Because we already understand each price phase and how it moves from one phase to another. How can we use it for a trade setup? It's very simple. One very important phase you want to be waiting for is consolidation. When price is consolidating, you're expecting what? An expansion. Okay, so here's an example. I'm using this example because it has majority of the price cycle. So this is the BTC, the 1-hour time frame. So let's take, for instance, price was consolidating here. You want to mark out the low, and then you mark out the high. So why is it consolidation? After price creates the range, you see how it has been dancing within this range. So when price is consolidating, the next you're expecting for is what? An expansion. And it will either expand and reverse. Already, if it's going to reverse, you have the higher time frame to tell you that price is likely to reverse. Let me look for an example, because at times our price might not reverse, it will just expand. Okay, there are times it happens like that. So this is a consolidation. You can see price was consolidating here, it just expanded lower. Okay, so now once price is consolidating, you see how price was consolidating here. You're expecting price to either expand away from that consolidation or expand lower, take liquidity, reverse. And if it's reversing, it's going to expand in the opposite direction of which price will not go before changing direction. And before you know what to expect, you have to start your analysis from the higher time frame. So let's go to the higher time frame. Go to the daily and we'll see something here. Okay. So here's the consolidation. Let's go to the weekly. All right. Now you can see that BTC is bullish. And what do we have here? We have a bullish order block. So I'm expecting price to find support after filling, because that's filled this favor gap completely. It took out liquidity below this low. Here is an order block consecutively down close candles. From here to here is a bullish order block. So I'm expecting price to rally from this point. So if we go back to our, I think it's our 4-hour, okay, 1-hour time frame. Okay, this is already messed up. So don't forget this red here. Let me call it red. Is our bullish order block. You can see how price, although something happened here, but this is just going to be a good example for us. Let me make this better for us to understand. The whole lines are just making it look clumsy. Okay. So remember, this line here is our bullish order block. So I'm expecting bullish prices. I'm expecting price to rally higher. So as a trader, I come to the market on this day, which is a Monday, and I'm seeing this happen. And I'm expecting price to rally higher. So if price should break below this low, that is this range that is breaking out of this consolidation. I'm expecting a reversal because I want price to rally higher. Another price before it rallies higher, it could either expand higher away from that area of what consolidation, or expand in an opposite direction to take liquidity before reversing. So if price is running lower like this, I wouldn't be scared. I would expect a reversal. So what do? I go down to a lower time frame to look for an entry here to buy because I'm combining what reversal plus liquidity. That is how we get a setup with reversals. Okay, so we'll go down to this area here and see if we can get a setup. So good, we have a setup. If you remember, I gave what an entry model, which is the inversion fair value gap entry model. And you can see how price closed above this fair value gap, came back down, find support, and rallied. So here you get a trade. Now let's say price expands without you, and you're unable to catch this move. You can see how price reversed, took this low before rallying higher. You're unable to catch this move. What do you do after an expansion? Because you understand that there are three things that could happen when price expands. It could either consolidate, reverse, or retrace. So the next thing you're anticipating to capitalize on is what? Retracement. But then remember, I said three things could happen, and you're expecting one to happen. So one of the things that could increase the probability of a retracement being the next price phase is if price has not gotten to the predetermined target. What do I mean? Now I expect that price should still keep rallying higher because here we have a high, we have a fair value gap. Remember, we're coming from the weekly time frame. There's a weekly order block. So I expect that price will find support to keep rallying higher, to take this higher and also fill this fair value gap. So there's still chance for price to keep rallying higher. And this is just the first leg. So the chances are still high that price should retrace and continue this trend. Okay. And with retracement, we pair it with fair value gaps. What is a fair value gap? Fair value gap is an area of inefficiency formed by three candles. So you can see we have three candles here. We have candle 1, candle 2, and candle 3. Now, the gap between candle 1 and candle 3, I think I should expand this so that it's clear for you guys to see. So here's the first candle, here's the second candle, and here's the third candle. So if you look at this, you notice that there's a gap between this candle here and this candle here. So here's the high, the close, here's the close, the open, and the low, because this is a bullish candle, this is an upwards candle. So price opened here, closed here, created a high, and it created a low here. So we use the full range. We're not just using the body because this is the body and here's the wick. So we're using the full range from here to here. So the gap between this candles range with this candle range. So we have what? This, and we call it the fair value gap. It means that we're expecting price to retrace into this area to find support and continue this trend. Okay, so let me play this. Wow. So we can see how price found support here and then continue rallying higher. All right, so we're expecting this high to be broken. So when we see this retracement, is an opportunity for us to capitalize on this trend. So this in itself is a trade setup. So to recap, when price is consolidating, to capitalize on that, you wait for an expansion. Now, price could expand without you. And if it expands without you, you wait for what? A retracement. You just identify the fair value gap and wait for price to retrace into that fair value gap and then go to a smaller time frame to look for an entry to buy or sell. But it doesn't expand and keep going in the predetermined direction. If it goes to the opposite direction, of course, at this point, you're expecting it to reverse. Once it takes that liquidity at the opposite side, what happens? You go down to a lower time frame to look for an entry model to take a trade towards the direction of which you expect price to go. So to give an example, if you're expecting price to be bullish and price is going lower after creating a range, if it takes the sell side liquidity below the low, you go down to a smaller time frame to buy. And if you are selling and price is in a range, you wait for price to go above the high to take the buy side liquidity. Then you go to a smaller time frame to look for an entry model to sell. I hope that's clear. Okay, so I've given you scenarios for two phases. So what happens when price is consolidating and you want to capitalize on the expansion? Let's look at it quickly. So here is a British pound here. Now you could see that price was reversing from this point here. It took out this buy side liquidity, then reversed lower. Okay, but mind you, before we go forward, this is a situation where It doesn't give you a reversal. It just expands away from the consolidation or expands away from an area of equilibrium. This is more advanced, and this is where you'll be combining the order block with the expansion. Okay, so I'm going to show you an example here. All right, so you can see how price is reversing. Why is it reversing? Because it took liquidity before going lower. And then one of the things you could know that price wants to go lower is that if you take this high and this low, where you want a premium, so want to sell at a premium, okay, and not just make this lecture too long. You can see that price already filled this area of inefficiency, and we're expecting lower prices, although price did not take this low. So this is a weekly time frame, guys. So this is a high and a lower high and a lower low. So we're expecting a lower high and a lower low to be formed. So as price retraces into this range, it's taking what internal range liquidity here. So expecting lower prices. So let's go into this area. I think I should take this out. Let's see what happened here and how we can capitalize on it. So if we go to the daily time frame, all right, good. We can see a little consolidation happening here. Why is it consolidation? You can see price created a range from this. Okay, let me give you time. Where do you think is a range? Here. Pause the video. All right. As ICT usually does in his own videos, he asks students to pause their videos. And definitely whenever he says that, I myself, I don't pause. I'm guilty of that. So I'm sure some of you too will never pause your videos. Okay, so let's just go straight to it. So we have this range low. So you can see price created a low, a high, a higher low, a higher high, a higher low, a higher high, a higher low, higher high, and price was inside this range. So from this low to this high, so we have a range. All right. So we're expecting price to break out from this range to go lower. So you can see as price broke out, it don't give an opportunity for retracement. But if you go down to a smaller time frame, you might see a retracement for it to capitalize on this trade lower. But as soon as price was at this point, it did what? Created what? An order block. So this order block inside this range, you're waiting for what? A change in state of delivery. What was a change of state of delivery? Is when the low of this consecutively up close candle. So I expand. Remember, this is just the area we're studying, and this is the range, and then the liquidity that was taken. So here's the order block that was formed, and usually the order block is formed at the area of equilibrium. So you could see this is equilibrium. Let me just take all these lines so it doesn't confuse you. Take this out and take this out. Instead, I think I should replace it with this here. So it makes more sense. Okay. So here's a range. And then here is our order block. All right. I think I should make it thicker. Okay. So as soon as price closes below this open, the open of this up close candles here, we're starting using this place. So as soon as price closes below it, it is a change in state of delivery. So once price returns back to it, we want to be selling. And you can see the immediate return in price. So we are using this order block to time what? Our expansion. All right. I hope this was helpful. As always, our order block. And if we go down to a smaller time frame, we would see it better. So you could see, you could as well adjust. So if you pick from this low to this high, you would see that this is actually a consolidation. Price was consolidating within this range, but we're able to time this expansion because there was a change in state of delivery inside this consolidation. And we can see another one here. There was a change of state of delivery. You can see price created this high here, this candle here, this up close candle. Price broke below it, returned immediately, and did what? Ran lower. So from the higher time frame, this would be the change state of delivery. But from this time frame here, you could see our price changed state of delivery here, and then broke lower. So you could time this. But as a new trader, you could just wait for an expansion. As simple as that. Now you can see how price expanded and then give an opportunity for retracement here. Now it's very small, but let me show you. Because if you look at this, we don't have any fair value gaps here. There are no fair value gaps here. The only fair value gap we have is this. So if I expand this, you see that price retraced into this fair value gap happening in the New York Q zone. So if we go to the 1 hour time frame, okay, so you can see how price expanded into the fair value gap. So you could be trading. So you can see how price rallied lower from this, or it happened overnight. You can see it's outside the Q zone. So if you go down smaller time frame, you want to find an entry here for a sell. All right. So I hope this was helpful. If you enjoyed this video, give it a thumbs up. If you have any question, please leave it in the comment section, and I'll do well to attend to it and also make videos and content based on those questions. And if you haven't subscribed to this channel, please do subscribe so you see more of my content. All right, guys. See you next week.